Happy New Year. This is Doug Gerlach from iClub Central. Welcome to our Lunchtime Stock Club webinar. Today is Monday, January 11th, 2016, a brand new year. And like many new years, it's already brought a lot of changes, and the market has been responding to the new year with a little less enthusiasm than in the past. But we'll talk about where the market is to date and where it might be headed later this year, what's driving the market, some of the factors, and what you can do as individual investors. So we'll talk about that, and we'll talk about some stock ideas, and feel free to share your best thoughts about stocks to look at right now as well. Before we begin our regular housekeeping, if you're having technical problems of any sort, please contact GoToWebinar right away. If you can't hear me, if the sound or graphics are choppy, if the screen isn't updating on your computer, please give them a call right now. They are standing by. It can help you get up and going right away. We remind you to turn off any unnecessary programs on your computer, and that can facilitate the speedy transfer of all the data and video and audio that's coming down the pipe for the webinar today. Don't use Wi-Fi if you can help it, and you can always listen using the telephone. Refer back to that GoToWebinar invitation email that's got all the details for how to dial in and listen. If you check that GoToWebinar application on your screen, you'll see the questions box. You can expand that and type in a question or comment at any time, and I will be monitoring those throughout the presentation. Hopefully we'll have time at the end of our presentation to address some open issues, but feel free to type in questions at any time throughout our presentation today. The handout for today's presentation is also available as a PDF right there in the handouts tab of that same application. So go ahead and click on that to download it, save it to your computer, print it out very quickly if you want to make notes, but it will also be provided when we archive this webinar on the iClub.com website. But as a reminder, we've been publishing those handouts in the application, in the GoToWebinar application during the presentation, so you can grab them right away. So make a habit of doing that as soon as you get in. You can save it to your hard drive, you can print it out, you can do both. Our complete schedule of archived webinars and upcoming webinars are available on iClub.com in the Learning tab. You'll see our schedule there. Pretty straightforward for the next couple of months. Next week is our Investment Club tax preparation webinar, one of our most popular webinars of the whole year. So if you are a member of an investment club, even if you're not the treasurer, maybe you want to remind the treasurer that next Tuesday night we'll be looking at the club tax preparation software that iClub provides and answering questions about how to prepare those club tax returns. We'll be doing another presentation in February for better investing on the same topic. So you've got two chances to catch that webinar live, and then you can also view the archives after the webinar happens. So please check on iClub.com for the complete update. If you haven't yet, you can find us on Facebook as well for occasional updates, special offers, and the ever so rare stock idea. Find us by searching for iClub Central. We won't be spamming you with lots of information there, but we will provide occasional updates. And it's a real easy way to keep in touch with everything that's going on at iClub Central. Well, so here we are in January 2016, and where did we end up 2015? Well, we were in a bull market, but certainly at the end it did not feel like it. So here is the entire 2015 calendar year in the market segments that I like to look at. On the top in red is the EFA, the Morgan Stanley Europe Australasia Far East Index so this is the developed world outside the US, representing large international stocks, and you can see they had a terrific first 6 months of the year, but then as we hit July, August, September, you can see that the EFA went from leading the major market segments that I look at to having a 9.3% decline for the year. Below that, in the kind of blue-green, is the Russell 2000 index, the small cap index, and you can see it also was performing better than the S&P 500 for much of the first part of the year, but then collapsed with the rest of the market in August and ended down 12.73% for the year. So small caps had a tough year coming off of some strength in the last couple of years before that. Really ended down mostly I think on concerns about economic growth. But I think it puts us into an interesting place for stock pickers as we head forward. But we'll talk more about that. And then finally, the bottom in the blue is the S&P 500, ended down 6.97% for the year. So when you look at the market overall, while there was a lot of strength going on at the first part of the year, the second half certainly saw some declines all across the market segments. And then that just propelled us into 2016. Here we are year to date. Since December 30th, you can see that all the market segments are down as of today. We've been losing a lot of territory in all the market segments here, the S&P 500, the EFA, and the Russell 2000. So you can see quite a big decline year to date. So we've still got concerns over China. Certainly the situation in the Chinese markets in August precipitated a lot of the weakness that we saw at the end of the year, and then some renewed weakness at the beginning of the year has tampered down results. The concerns about the economy, I think, are probably at the foremost of a lot of investors' minds. If we look at the S&P 500 PE ratio, you can see that the valuation there has come down a little bit from the peak that it was earlier in the year, but it's still in sort of at an elevated level, I'd say. It's not anything that is in nosebleed territory, as we saw at the end of the 1990s bull market, or at the end of just prior to the 2007-2008 financial market meltdown. But you can see we still are at a pretty rich multiple. We're down just a little bit. In December, when we met for our Lunchtime Stock Club meeting, the S&P 500 PE ratio was at 21.18, so now down to 20.24. 20.24 is lower than the S&P 500 PE ratio was in most of 2015, but higher than it was in 2014 when we started tracking this on a regular basis in our Lunchtime Stock Club webinars. It was when we started out in March of 2014, the PE ratio of the S&P 500 was 19.9. It was as low as 19.3 in August of 2014, and then dropped to 18.4 in October of 2014, and it's been climbing up to the 20s and even as high as 21 in December before kind of sliding back down a little bit. So you can see that the market has retreated a little bit in its valuation of the S&P 500 with respect to earnings. And if we look at the S&P 500 earnings, again, we can see a little bit of weakness there. The S&P 500 had reached record high earnings earlier in 2015, and now a couple of quarters later has declined a little bit. And this is what the concern is in a lot of market watchers, that the big companies are seeing their profits slowing, that we've seen enough recovery to generate some increased profits for many large company stocks. Now interest rates are are somewhat higher. I don't think that has a real big impact on the cost of capital for most big businesses, or it's going to inhibit them from making expansion plans. But I just think that the fairly long expansion mode of the economy that we've been in has reached a certain level at which the efficiency is pretty much maxed out. So it's going to be much harder for companies to find ways to continue to make money with the resources they have. And consumers have been a little slower in this expansion to spend the money they've got, which is kind of interesting. The Americans have never been big savers compared to some other countries, but we've been seeing Americans kind of holding on to their cash a little bit harder following the Great Recession, I think, where it hit a lot of people hard in 2007, 2008, 2009. People have been reluctant to spend as much of their raises and the increased Hanco pay they have. And so put all those factors together, I think a lot of people are looking at 2016 and thinking, gosh, we've had the second longest bull market on record, and we would have been coming into one of the longest bull market stretches in the first part of 2016 if the S&P 500 had been continued to kick upward, but that's not what's happened. So we've had this correction in course, and the problem with bull and bear markets is that a lot of it is psychological, a lot of it is fundamental, and you put the two together, and it almost seems like it is predestined that we're going to see another rough year in 2016. I think at the beginning of 2015, my expectation was for a somewhat rocky year, perhaps 5 to 8% gains in the overall market, driven by economic gains of the S&P 500 companies. Turned out to be a little worse than that. Certainly not the big bull year that a lot of people were hoping for, I think. So this puts us in kind of a precarious position, I think, for the year going forward. Certainly the fourth quarter results, when they start coming in March, end of February, March, are going to be very telling about the strength of American business at that time. If companies start exhibiting a lot more weakness than is expected, I think then we're going to be in, really all the pieces are going to be together for perhaps some extended market downturns, or the bear that everyone has been expecting for some time going forward. A little bit of strength, however, could continue to sustain stocks, and certainly if we get a handle on what's happening internationally, if China gets a handle on what's happening with its markets, that could have a beneficial effect. But a lot of that negativity is priced in at the current point. So whether or not we're going to have a bear market, I think it's always good to keep a few things in mind. One of them is that things usually get worse before they get better, and certainly the market is down now from the highs of late 2016, down quite a bit year-to-date last year, and now we're seeing that decline at the beginning of this year. So things could always get a lot worse. When you look at the PE ratio of the S&P 500 at 20, it still is pricing the market as though companies are going to continue to perform well. So there is a lot of underlying optimism, I think, that whether it's warranted or not may be the big issue. But we can never predict short-term market direction. So the best we can do is maintain our focus on the long term. But what we can do is go through our stock wish list, go through our current holdings, identify the high quality companies, and be ready to buy when the price is right. And so we'll be looking at a company later today from one of our recent newsletter selections that I think is one of those kinds of companies that was a little expensive when we picked it, but it was the best that we could find at the time, and now the price is down 15 to 20%, based not on the fundamental weakness of the company, but just based on overall market valuation. And so I think those are the kinds of companies that we like to be looking for, liking to be adding to positions in our existing portfolio, or swapping out stocks that may be weaker with stronger candidates. And then when the market does recover or does go through that bull bear bull cycle, we will come out ahead than if we just simply managed our current holdings with a strict buy and hold philosophy. So we want to challenge and upgrade as much as we can. In nautical terms, we should be continuing our present course and speed. We're not changing directions because of the direction of the economy, because of the direction of the market, because of the way that we predict winds may blow, or the way that someone predicts winds may blow and currents may flow. We're going to continue to keep our eye on the long term as we go forward, and we're going to invest accordingly. As always, we're not buying the market. We're buying good companies at good prices. And hopefully, after this period of somewhat extended high valuations of companies, we're going to have the opportunity to buy those good companies at better prices if the current climate continues in the direction that it's been headed so far and seems to be signaling as we start 2016. The bottom line is we don't want to panic. We want to understand that this is a normal market. This is typical of what happens over the long term, the expansion and contraction of the economy, of the market, and the forces that affect individual stock valuations continue to work just as they have been in the past. Which brings me to some words of wisdom, and this time we turn to Money Magazine, the long-standing monthly publication that deals with money and personal finance. And we're gonna take a look at some text-heavy slides here, but I just wanted to cover this article entitled "Market Madness: What Should You Do?" That Money Magazine published. And they said, everything has changed. That's the sentiment on Wall Street since the stock market began slipping and share prices started swinging with extraordinary velocity. The bull market that would never end is now suddenly viewed with great skepticism. But really, what did we expect? After all, the years leading up to this were truly an aberration historically, and now reality has returned. This is how markets act. Still, sudden shifts precipitate fear. Is it time to sell? To question your assumptions? To revamp your whole approach? Probably not, at least not for those with appropriately balanced portfolios. But that doesn't mean some changes aren't in order. We're not going to abandon our basic principles that stocks are the best long-term investment, that buying and holding in good companies is far wiser than frantically shuffling in and out of the market. But we also recognize that when there is blood in the water, when the market overreacts, as it always does, going up and going down, there are opportunities for investors who see beyond the moment. And I think that's a pretty, Money Magazine often gets a bad rap for its focus on short-term market moves. But I think in this case, we have got some good food for thought here, that we have the opportunity to benefit from this kind of knowledge. And it certainly fits with our approach as Better Investing members, as Toolkit users at iClub Central, that we're not going to worry about what's happening in the short term, but we're going to focus on what goes beyond and what goes ahead. I think you might all agree with the sentiments from this particular article, but you might also be surprised to hear that it's from their cover story in November 1998. And it just goes to show you, the more things change, the more they stay the same. So 17 years ago, Money Magazine was covering the end of the 1990s bull market and the first signs that perhaps things were changing with the same message that I think we've been hearing today, 17 years later. What has changed? We've had bull markets, we've had bear markets, but the wisdom of investing for the long term remains firmly in place. The message from Wall Street that you're not smart enough to be an investor if you're an individual without the guidance that they provide is simply not the case, and that if we focus, as we do, not on trading, not on predicting the future, not on market timing, but on long-term sound principles of investing, that we can perform well over the long term. The more things change, the more they stay the same. And that's my position with respect to the state of the market today. We're going to continue to invest as we always have, and we're going to look for opportunities, and we're going to move forward with the best companies that we can to weather the storms in the near term and provide us with suitable cover and returns over the long term. So with that, let's take a look at a stock of interest. And again, feel free to share your best ideas with us today. But this company is N5 Holdings. The ticker is NVEE. NVEE, trades on the NASDAQ. We recommended this in our Small Cap Informer newsletter in November 2015. This is a small technical engineering company. And when I say small, I mean small. The 2014 revenues were $108.4 million. The price on today was $17.55. When we recommended it in the November issue at the end of the month, it was $22.60. So we've seen a $5 price drop since initially recommended, but at the current valuation level, we've seen an indicated total return of 28% a year. So what does this particular company do? Well, here's the graph. Been public since 2010. However, the company's roots go back to 1949, and they went public in 2013 in their present form. They do technical engineering and consulting for both public institutions and private clients. And they've got a number of verticals that they work in, including construction quality assurance, infrastructure, energy, program management, and environmental. But they're not really a very small operation. They've got 42 offices in 15 different states currently. So they do have some diversification there. And some of the high-level project and customers you might recognize. They've got a business working with the builders of large sports centers and sports arenas as well as airports. So Qualcomm Stadium, Rose Bowl Stadium, Citizens Bank Park, Princeton University's football stadium, the airports in Philadelphia, Fort Lauderdale, Miami, and Newark are all among their client list. And out of the top 500 design firms and the top construction management firms, the Engineering New Record, which is the one of the industry publications that covers design and construction firms, ranks NV5 124 out of the top 500 design firms and number 69 out of the top construction management firms. So this is an established business. They have a good track record and they have a great reputation. The growth since 2011, revenues have been growing at 18.9% a year. Again, not with the consistency that we might want from a larger company, but as a smaller business, they're growing quite well, just not as consistent, but the strength of the growth is pretty strong. And the third quarter ended September 30th, revenues were up 55% and earnings were up 23%. So they continue to perform well. Earnings have been growing quite well as well in the last, since 2011, up 28.2% annually. And you can see the most recent quarters there coming in, again, strong, each one better than the one before. Well, one of the things that we liked about NV5 is that many of their verticals, the areas that they focus on, have to do with segments of public capital use that are in high demand, including highway and bridge infrastructure. According to the American Society of Civil Engineers, there's about $3.6 trillion of public investments that are going to be required over the next 15 years to improve the condition of our nation's roads and bridges. And that doesn't mean expanding the number of lanes on highways, but that means strengthening, rebuilding bridges that are crumbling and other infrastructure. And there's an increasing amount of public will to get those repairs done after some of those high-profile catastrophes that we've seen in Minnesota and in California, where highway bridges have failed. We need to really take a look at this as a country and deploy assets. And NV5 is one of the companies that will be involved in that. They do make acquisitions from time to time, and we have, in this case, the company has given some good guidance for year to date. So we know that fourth quarter full fiscal year earnings and revenue figure that we see right here is pretty much on track with what the management had to say at the end of its conference call when it reported third quarter earnings. So we've got a good sense that business is strong going ahead. And that's going to be pretty positive. Now, they do have some dilution that's come from the issuance of some secondary offering of shares back in May of 2015, but the earnings per share figures you see here are fully diluted. So we've taken all of that, those additional shares, 1.6 million shares, and have incorporated them into the earnings per share figure. So even with the dilution, the company has been performing a little well. And you can see the earnings line kind of falling short of the pre-tax profit and sales line. You see the growth here is much less than here and here, and that's the impact of the dilution. Now, we hope that the company will be able to deploy that capital, making acquisitions, paying off debt, and leveraging further growth as we head down the line. Now, this industry group, engineering and construction, is pretty economically sensitive because often during economic downturns, it's less likely that large capital-intensive public projects are going to be constructed. But Value Line ranks NV5 as number one for timeliness over the next 12 months. So they really are a standout in their particular business, and we think that it's pretty timely despite what's going on. I'm going to flip over to the stock study in Toolkit. You can see here the pre-tax profit margin has been expanding pretty nicely as well. So we always love to see companies that are able to become more efficient as they grow larger and see them getting bigger as you go. So that's been a pretty good sign as well. So when we're looking at the current price of $17.55, as we scroll down, we've given them some additional PE leverage expansion. We think the company can, if they're going to continue to grow at 18 to 20%, that a PE ratio of 25 will eventually be achievable. In the short term, it may not reach that high. It's currently at a PE ratio of 16. It's been as high as 25, though, in the last year. And so that's the basis for our high PE. So here you see the 52-week high PE of 25. So that's not factored into the relative value or any of the other values, but we do use that as some guidance, thinking that as the company matures, it may reach that higher PE ratio in 5 years. And that would give us a 5-year target high price of $60 based on our growth. On the downside, the low PE of 9.4, which they did reach in the last 52 weeks, times the trailing 12-month earnings of $1 gives us a downside price of 10. So the As you scroll down through here, that gives us, and I'm not inclined to change any of this judgment. This comes from our publication SSG. I'm not inclined to change any of those values at this point. It gives us a buy price up to $22.60, which is a 5.7 to 1 upside downside and a 28.1% compound annual return through if the company does reach that $60 price target in 5 years. So Walter asks, what would you do if you got in when it was first recommended and now you need to increase 27% to get back to even? That's always an interesting problem to have, interesting question. I refer back to my comment earlier that things are probably likely to get worse before they get better, and so it may be the case where you cut your losses, sell to cut your losses now, capture the gain, and then in 31 days you might consider buying the shares back on the hope that the price would still be at a more attractive level at that time. So that would be one strategy that you could use. The other is to double down, to buy additional shares and average your costs down if you were convinced this was still a good opportunity, and then go from there. So two different approaches, and I would be I'm fairly, I can't give you specific advice. I'm fairly neutral as to which you might do. My feeling is that we're not going to see a quick recovery. That if we do have a bear market, hopefully it'll last less than a year. On average, bear markets only last 6 or 7 months, so they seem to last much longer, but in reality, they don't. So, but then it just takes time. Everything doesn't go back to where it was previously in the matter of a couple of weeks. It may take a couple of days or a couple of months, a couple of quarters for the upswing to fully kick in. So those are some things to think about. If you have or expect to have capital gains later in the year, I know it's a little rough trying to match capital gains so early in the year, but that might be something to do, to match, to harvest the loss now and then return to the company later on. So this is NV5. Again, I think interesting company. We've previously had an engineering technical consulting business that we tracked in our small cap informer, and it just didn't work out. I think that particular company had overextended and just was really, it didn't have the business to sustain the growth that they were planning for. So that just never materialized. But MV5 is in a different, I think, is in a different position. Now, one of the risks that comes from a company like this is that it is so small that it really will take a lot to drive the price upward over time. They need to continue to execute well. They don't have very much institutional ownership, institutional coverage at all, because they're just too small. Their institutional ownership is just 46%, which is respectable for a small company stock, but it's nowhere near the institutional level that you'll see in most large cap stocks, which is 70, 80, 90% owned by institutions. And so without that institutional support, the price tends to grow a little less quickly. But I think this is still remains an example of the kind of company that now is more attractively priced. We might want to swap into. If you're looking for small company ideas, here's one to challenge current holdings in and see how they might perform. All right, let me just wrap up. Where am I going to be in the next couple of months? We've got a couple of events lined up. Next week, I will be in Minneapolis at the AAI chapter there. speaking at their chapter meeting, the Twin Cities chapter of the American Association of Individual Investors on January 21st. March 3rd to 5th will be at the Money Show. iClub Central and Better Investing will be there. I'll be presenting 2 classes and also sitting on a panel with Mark Hulbert and other investment newsletter editors, where we'll talk about other ideas and strategies for a bear market. In April 1st, I'll be presenting a workshop all day for the Southeast Florida Better Investing chapter. So this is in the Fort Lauderdale area. And then in April 30th, I'll be returning to Cleveland to the Better Investing chapter there for another half-day workshop that will work out. We've got our webinar schedule published on iClub.com. There is one change to the Toolkit 6 user group that won't be happening in March because of the Money Show and my travel schedule, but the rest of the events are all there for you to peruse. So I want to thank you all for joining us today. Stay the course. Remember that we are long-term investors, and what happens in 2016, even if it's a terrible year, will just position us for further growth in 2017. Focus on those high-quality companies, focus on well-run businesses, focus on buying them at the right price, and that's how we're going to find success over the long term in our stock portfolios. I wish you all the best, and we will talk to you next month at our next Lunchtime Stock Club meeting.